All right, folks. Well, hello and welcome back, as always, to the Money Wisdom Podcast powered by Johnson Brunetti. I am one of your hosts, Nick Colantuno. I'm a certified financial planner up here in our Boston, Massachusetts offices. Jake, my friend, good to see you. Welcome back.
Yes, thank you. My name is Jake Dozer. I'm a certified financial planner in our Connecticut offices, and looking forward to our podcast today.
As always, my friend, we're glad you're back with us, viewers and listeners. We've got a pressing topic for you all today because as the year end approaches, so too does a lot of the planning that you need to consider before the end of the year. So a lot of the conversations, Jake, I know at least the conversations I'm having with clients, I'm sure the conversations you're having with clients right now are really about how to maximize some deductions, maximize some tax planning opportunities, just things in general that you need to be thinking about before December 31st. So things to take advantage of while we're still in the 2025 tax year. So again, you're aware, I mean, tax planning isn't just about lowering your taxes. I really say that the job of a CPA or the job of an accountant is to say, hey, client, how do we minimize your taxes for, today or this year? Our job, Jake, as financial planners is saying, hey, yeah, that's part of it, but we're really looking to minimize taxes for the rest of our clients' lives.
That's
right. So two very different lenses that we look at things through. So first off, here are 5 tax moves that clients, listeners, viewers, really everyone out there should be considering acting upon before the end of the year. So I'll just throw these at you, Jake, and you can provide some sage advice and wisdom to our viewers. So the first thing everyone should be considering is maximizing their retirement contributions. Isn't that right?
That's right. You can get money into your retirement accounts, your IRAs, your 401ks, 403bs, et cetera. And every year that balance resets. They're not like, rollover minutes from back in the day. They don't pile forward. In Canada, they do, fun fact, but not in the United States. If you want to see Canada's plan roll out, write your congressman. That's not our job. But what we can tell you is that as of 2025, the contribution limits, if you're below 50 years old, is $23,500. If you're over 50 years old, it's $31,000. And then there's a special window that as of June 2025 didn't exist. This got kind of rolled out through the big, beautiful bill, which was if you're 60 through 63, your contribution limit is actually a little bit higher. It's $34,750. Fun fact, 403bs have always had a special provision window where you can actually get a little bit extra in them, but kind of a lesser known thing. 401ks now have that opportunity. I think this one is especially timely as we come to the end of the year because this is the time to make those moves before the year starts. And now you don't have that window, number one. Number two, going into 2026, the rules around 401k contributions are going to change. In one hand, your contribution limits will increase. But on another hand, pre-tax contributions are going to be adjusted. So if you make over a certain threshold, you cannot make pre-tax catch-up contributions. So that amount over the 23.5, that amount will not be able to be put into pre-tax starting in 2026. If you make over certain income thresholds, it will then be required to be Roth. And that might not necessarily for all people be a bad thing. Just be aware of it. The government is saying, hey, we want some tax revenue now, and that's their motivation. So if your 401k provider doesn't offer Roth, it means that you might not be eligible to do catch-up contributions any longer. If they offer it through the employer, which nowadays more often than not they do, then you might be okay. But if they don't offer it, it might be something where you need to have a conversation with a financial professional about, okay, what other options do I have if I can't put more into my 401k? Do I need to use a Roth IRA? Do I need to do a non-deductible traditional IRA contribution and do a backdoor Roth conversion? Do I need to use a brokerage account? Etc. So have that conversation. How am I getting as much tax bang for my buck now? And a larger conversation should be, should I be getting a tax write-off now, or should I be biting the bullet now to try to save taxes later, like Nick mentioned? So you really need to have a long-term strategy of what am I doing in this season of life, and going forward, what am I doing? Because if we're not paying taxes now in an effort to save income tax, then we need to pay taxes later. But if the taxes later are more dangerous than the taxes now, well, then maybe just get it out of the way. So let's talk through that.
Absolutely. That's really well said. And viewers and listeners, like that is a great advertisement for why you need to be having these conversations with someone who does this all day, every day. I mean, those last 2 minutes of what you just said, Jake, I mean, everyone should just replay that back 3 or 4 times because there's a lot that gets thrown at you. I mean, I find that so interesting, that additional catch up for folks who are, from 60 to 63. That's awesome. And then thinking about what you also said about the year ahead, where they're increasing the contribution limits, but actually decreasing the flexibility that folks have when choosing where that money goes. So many moving parts. And I think that's just a reflection of kind of the tax code that we have right now. So thank you for that. Strategy number 2 goes all along the lines of required minimum distribution. So this is relevant for those folks who are at this phase of life where they're now being forced to take taxable distributions from these accounts by the end of the year. So tell us what those conversations look like with your clients, Jake.
Yeah, I mean, at a bare minimum, if you're eligible for an RMD, or maybe at that window of time where you're required to take an RMD, which you remember is 73 now. A few years ago, it was 70 and a half, and that was the rule for a long time. Then it changed to 73. And now, actually, speaking of changes, if you're born in 1960 or later, your actual RMD age is at 75. And so these shifting numbers look like that. And so you need to be able to make sure your RMD is taken this year. If this is your first year you've had an RMD, you can delay your RMD until April 15th of 2027. Although, let's face it, in rare instances, would you want to do that? Because that means you got to take 2 RMDs next year. So unless for some reason you got like a long-term incentive payout that's going to hit your bank account this year where your income's wildly higher than next year, maybe that's why you delay. Beyond that, you probably want to just take it now. You need to figure out where you're at in your tax bracket and where you will be next year. You need to be looking at where are you taking your RMD from. For instance, with our clients, they might have a variety of IRAs that are serving different purposes. Maybe one's safe, maybe one's low risk, maybe one's high risk, whatever it may be. Point being is we might not actually take the RMD from each account. We might take some of it from account 3, whereas accounts 1 and 2, we don't. Right. So with IRAs, you can mix and match. If you got a 5,000, 5,000, 5,000 from 3 IRAs, well, you could take 15 from one and 0 from the other 2, or 5, 5, and 5, or some other combination. You can't do that note on 401ks, right? So if you've got multiple 401ks or multiple 403bs, can't do that. You can't do an IRA, can't satisfy a 401k, RMD, and vice versa. So just keep in mind that, there's some flexibility if you're using the right vehicles for your investments, but certain vehicles are more restrictive and less flexible. So make sure you don't get hit with that big tax bill or excise tax, if you will, that you get hit with if you don't take your RMD. And make sure that if you're yet to the RMD age, you're thinking about it, because down the line, you don't want to be put in a situation where you're painted into a corner where you're forced to take out RMDs that are much higher than had you extracted that money in lower income years and therefore paid less taxes. Because keep in mind, your RMD goes up over time. And so at age 73, the amount your RMD will be is different than what it'll be at age 80. At 80, they'll be forcing you to take out a lot more money than at 73. So don't get into a trap where you don't want to pay taxes and you delay it so long that now at RMD age, you got nowhere to go. You have to take them out now, whether you want to or not.
Yeah, we see that all the time. Folks can be 10, 15 years into retirement, and then all of a sudden they're in the highest tax bracket they've ever been in. So, required minimum distribution planning is really important when it comes to your own money and your own retirement accounts. It's also a consideration for money that you've inherited, because the rule now states that if anybody leaves money to you, let's say they're a parent, a grandparent, aunt, uncle, right? Someone who is not within 10 years of age of you, you have this new 10-year forced distribution timeline in place. So what that means is, let's take a scenario where someone is of RMD age, so over the age of, let's just say 73, and they leave money behind to someone who is not yet RMD age. Because that decedent was taking RMDs, the person who inherits that account has to continue taking required minimum distributions. Now, because they're significantly younger than the decedent, they're going to be forced to take RMDs based on their life expectancy, which is going to be a very small amount of money each and every year. But don't rest on that, because what that means is by the end of year 10, all of the money remaining in that account is going to have to come out. So RMD planning is not just for, you in your retirement years, but also for any assets that have been left behind for you. And what we also see, and Jake, I'm sure you've seen this as well, is there could be both of those scenarios at once. In other words, someone is not yet at their RMD age, but they've inherited money that they're going to have to take required minimum distributions from over a 10-year period that will then overlap with the start of their own required minimum distributions. So this is where, from a financial planning standpoint, we have to go up to 10,000 feet and look at all of these things across the board, because
That's right.
Clients can really be caught off guard from a tax standpoint. So have these conversations. Next, what we want to talk about, topic 3, is finishing any charitable donations that you plan on making before the end of the year. So I know this is something you're having lots of conversations with your clients about, Jake. How do you navigate it?
Yeah, so one of the biggest things we're talking about is qualified charitable distributions. A qualified charitable distribution, a QCD. That's when you're taking money out of an IRA and you're sending it directly to the charity instead of taking a taxable distribution to the bank and then writing a check to your church, synagogue, nonprofit, whatever it may be. I used to be a pastor, so I'd see this a lot of times, is somebody would send a check from an IRA to the church, bypassing the recipient. The benefit there is that the institution gets the same amount of money or more, but the person who owns the IRA doesn't pay taxes on it. So if I withdraw $10,000 and I pay $2,000 in taxes, I net $8,000. And then if I write that $8,000 check to a charity, all right, great. Well, there's nothing wrong with that, but a better way to do it is for you to take that $10,000 and send it directly to the charity, thus bypassing yourself and thus paying no income tax on it and satisfying a required minimum distribution. You need to understand the planning of determining, A, of course, that's going to save you taxes. You're not eligible to do this until you're 70 and a half years old, and you can do $100,000 per year. B, you need to figure out, though, can you afford to gift and how much can you afford, right? So just be aware there's a few things that go with this, but if you're charitably inclined, you're doing charitable giving, then you need to be considering this as part of your arsenal, because you can gift the same, if not more money, and pay less or no taxes on it. It's a win-win.
Yeah. So, Jake, I know another one of the popular year-end tax planning conversations we're having with clients are around charitable donations, and I know you're probably one of the advisors who does a lot more of this than most of us. So, tell us about those conversations you're having. How can clients really take advantage of some of the tax laws when it comes to charitable gifting?
Yeah, so there's a few different powerful methodologies through which you can give and reap better tax benefits than had you given in other ways. So one of the most common ways is a qualified charitable distribution. That's where, normally what's happening with most of our clients is they're withdrawing from their IRAs here and there, and then they're writing the checks to their charities as they see fit. Well, there's nothing wrong with that, but there's a way for you to be able to gift the same, if not more money, and pay less taxes doing so. So for instance, instead of me taking a $10,000 withdrawal from my IRA, I get $8,000 in hand after taxes, and then I send that $8,000 to my local church or charity. Well, instead of that, you could say, I want to cut out the part where I get involved. And by doing so, you're executing a qualified charitable distribution where the money is going straight from your IRA provider to the institution, the charity, and thereby passing income tax. So in that example, that $2,000 in taxes is just getting totally not applied to the person's tax return. And instead, they could just send $8,000 clear to the charity directly, no income tax, or send the whole $10,000 if they want to allow their tax portion to be added to the contribution amount. And effectively, the client doesn't pay any taxes. The charity gets the same, if not more money. Everyone's happy, right? So that's a way for you to be able to bypass taxes entirely. It does require IRA assets. You can't do this with the 401k. It requires you to be 70 and a half or older. It requires you to do $100,000 or less per year. And it also requires you to have a larger conversation, which is how much can I afford to give charities, and gifting in general, and how when should I do it? Do I want to do it when I pass away? Do I want to do it during my life? In this example, a lot of folks like it because you're killing two birds with one stone. You're getting the same amount to charity, and you're also satisfying your RMD and not paying any
Mm.
taxes. So that's kind of a win-win-win. There is another way you can do it with non-retirement assets as well, where you're gifting highly appreciated stock to a charity. And by gifting the stock to them, you don't have to sell the stock for gain. I've got two clients in the past week that we've done that. Hey, Apple stock, here's given to the church. The church sells it, doesn't pay tax on it because they're a 501c3. They get the whole amount. The person gets a write-off. Or another client gifted about $110,000 to a charitable trust that had $20,000 in gains that she didn't have to realize. Now that charitable trust kicks income out to her for life, and then the trust will pass to the charity tax-free because charities don't pay taxes, income tax. So it's a win-win-win. So there's a lot of different ways you can pull these levers. Long story short, don't just give money without having a conversation with your financial planner. Make sure that you know the best way to give that money and also get the tax benefit. Win-win.
Absolutely. It can be extremely powerful planning. So, folks, this is a good time to offer you all our Are You Paying Too Much Taxes in Retirement Guide. It's a great resource. If this conversation is, hitting you at all, whether it's one of the topics or maybe all of them that we've covered thus far, you're going to want to get your hands on this guide. Again, it's the Are You Paying Too Much Taxes in Retirement Guide. Text the word offer to us at 800-757-0436. Once more, offer, OFFER. Text us at 800-757-0436. We will get you your copy of the Are You Paying Too Much Taxes in Retirement Guide. So moving on here, taxes are what it's all about. And as the year ends, you mentioned for this client who gifted highly appreciated stock, what about a client who wants to keep that highly appreciated stock, but maybe wants to shave a little off the top and do that in a tax efficient way? What I'm getting at here is this tax loss harvesting strategy, which is something I know we're all having conversations with our clients about. But shine some light on that for us if you could, Jake.
Yeah, if you have non-retirement investments, so like a brokerage account they call it, and it's got some funds in it, stock, bonds, ETFs, mutual funds, whatever, that have grown. Well, you don't pay taxes on it until the gain is realized, meaning you have to sell the fund. Other than dividends, capital gains tax, right? Those are sometimes taxes you can't avoid on the way, but you pay the taxes when you sell the fund. Well, one of the things that you need to be looking at is in a year like this, having a well-balanced portfolio, it's never that all of your investments are moving in the same direction at the same speed and the same time.
Mm-hmm.
What that means is you may have funds that are good long-term investments, but in short term are down. Well, that's not necessarily a bad thing if you can leverage it appropriately. If you intentionally sold a stock that had a loss and at the same time sold a stock that had a gain, and the gain and loss balanced each other out, your net result would be a zero gain. And so you effectively could extract yourself from two different stocks or two different funds, and the taxes counteract each other and you don't pay any taxes net. You may intentionally sell some funds that are at a loss just to lock in that loss to be able to use as a write-off in your tax return. Or you may execute tax gain harvesting where you say, hey, I just retired, my income's pretty low, and because of that, I actually want to intentionally incur taxable events. Why would you do that? Well, because if you do that, you'll either pay little or no taxes if you do it the right way. If you're married and your income's below $96,000 and you experience a capital gain, no tax on it, 0% tax. Or if you're over that and you experience a 15% capital gain, maybe that's better than a 22% income tax, right? So it's not about avoiding taxes. That's impossible. It's about timing taxes and
Mm-hmm.
pay your fair share. Just don't leave Uncle Sam a tip.
You're exactly right. And that's a nice segue into topic 5, the fifth tax move that folks should be thinking about before the end of the year. This one being Roth conversion planning. So
Yes.
you shine some light on that, but tell us a little more. What should people be thinking about when it comes to Roth conversions, and why does December 31st matter when it comes to that?
Roth conversions need to be executed by December 31 if you want to count them for 2025. So you need to be evaluating your portfolio. And again, as I mentioned earlier, when we were talking about RMDs, you need to be thinking about not if I want to pay taxes, but rather when is the right time to pay taxes. So you need to be thinking about your life stage. Am I in high income year because I'm still in my peak earning years? Am I in a income valley where I've just retired and my income's low because that doesn't cost me a lot to live? Am I on the doorstep of RMD age and I want to reduce my RMDs? Am I in a situation where I want to make sure that I pay taxes now because I'm married so that if my wife or my husband survive me, they're not stuck with paying more taxes on the same income, since single people pay more taxes on the same income as married people? Maybe you want to pay some taxes so that your kids don't inherit an account like Nick mentioned before with inherited IRAs, and now they're forced to take out distributions in their peak earning years. It doesn't matter what your goal is. There's a variety of purposes that can be served by proactive Roth conversions. Again, it's all about let's fill up low tax bracket income years and let's avoid high tax bracket income years. When's the right time and what's the right amount to pay so that you pay less by the end of your life? That's the spirit of Roth conversions and really tax planning at large.
You're exactly right. And folks, if you want more information on this, you want to hear about some of the strategies we're using, what our philosophy as a firm is when it comes to all this stuff, get your hands on our guide. Are you paying too much taxes in retirement? You can get this guide by texting the word offer, OFFER, to our team at 800-757-0436. They'll get you your copy of the Are You Paying Too Much in Taxes in Retirement guide. I know it's a mouthful. Text the word offer, OFFER. Text it to us, 800-757-0436. So, Jake, here we are again at our mailbag minute. And
Yes.
folks, as always, we appreciate the questions. Keep them coming. You never know. You might hear one of these segments that Jake and I do, and you might say, hey, that's my question. And then, we'll get you your free copy of the Are You Paying Too Much Taxes in Retirement guide. So,
That's right.
Hey, win-win. So let's address our first question here, Jake. Kicking things off, we've got a question about helping with college costs.
All right.
How can I make tax-free gifts for college scholarships? And can I use my 401k to do it?
Can you use your 401k? Yes. Is it the optimal vehicle from which to gift? Probably not. Remember those qualified charitable distributions I mentioned earlier, listener? Can't do that from a 401k. Have to do it from an IRA. So, can you do it? Yes. Will it be tax-free? No. Is there assets that you can gift to a charity or a scholarship fund tax-free? Yes, but not 401k assets. We need to have a bigger conversation to see if you have the other types of assets to qualify.
Well said. Next up, a question that comes up a lot when it comes to Roth conversions. When is it too late to start a Roth? And is it smart to move my company 401k into a Roth when I retire?
So it's never too late to start a Roth. A lot of times people associate the fact that Roth contributions can only happen when you have earnings. The keyword contribution. That means earned income. W-2, 1099, farmer income. When you are in retirement and you no longer have earned income, now you can convert into a Roth, moving existing pre-tax dollars into a Roth IRA. Would you do all of that at once, like this question sort of suggests? Most often, no, because the goal is to pay less taxes, not force you into an obnoxiously high tax bracket. So the short answer is it's never too late. Some strategies will be optimized by starting sooner. It becomes less effective the later you wait, but it doesn't mean it's not effective.
Yes, exactly. And oftentimes, folks come in and they say, what if we just rip off the Band-Aid, just convert it all right now? It sounds good in practice, but when you put pen to paper and you look at the numbers, the math often does not math.
Yes.
So anyway, finally, we've got a question about employer-sponsored plans. And this is one that surprisingly you hear a little more often than not. Are 401ks and 403bs taxed the same?
Short answer, yeah. Whether it's 401k or 403b, they most often offer a pre-tax as their default option or a Roth as the after-tax option. So very, very common that 403bs offer less Roth IRA options. But long story short, once you withdraw the money, if you have yet to pay taxes on it, you're going to pay the tax upon withdrawal. There is one exception with 403bs, which is for pastors. If you have a retirement housing allowance in retirement, you can actually extract money up to that housing allowance money tax-free from a 403b. But, that's one employment opportunity in America that offers that. Other than that, long story short, yeah, they're worth the same.
All right, my friend. Well, look, folks, listeners, conversations that you have to be having, not that you have to do this or you have to do that, but you certainly have to have the conversation around it and see if this makes sense for you. Everyone's situation is different. Nobody knows that better than you, my friend Jake. So we appreciate you as always. We appreciate the advice. Viewers, listeners, we appreciate the viewership and the listenership. So thank you as always. I'll take this opportunity to sign off. I am Nick Colantuno. I'm a certified financial planner up here in Boston. And for my partner on the podcast here, Jake Dozer, certified financial planner in our Connecticut offices, we thank you as always for joining us on the Money Wisdom Podcast, and we'll see you next time.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.